Hello everybody, I am Pravesh Agi. Welcome to my channel. I am a chartered accountant currently working as a visiting faculty with the Institute of Chartered Accountants of India and associated with many universities in India. In today's lecture, we are going to talk about security analysis. Now, this is your CA final course, Paper 2, Strategic Financial Management, and I am CA Pravesh Agi, professor for this lecture. So now we'll understand what are valuation ratios. Now these ratios are very helpful in making investment decisions. So we'll understand price earning ratio, then we'll understand the price to book ratio, and finally we'll be doing the dividend yield ratio. Now let's begin with the price earning ratio. Now it is also called a PE ratio. The formula for calculating the price earning ratio is the market price per share, that is the price which is prevailing in the stock exchange, divided by earning per share. So we get a price earning multiple. Many companies trade at a very high PE ratios. Why they trade at a high PE ratio? Because their profits are growing at a rapid pace and they have a great potential to grow in future. So they command a high PE ratio. Or investors are buying these shares even at the higher prices and creating a demand for these companies. So they will normally trade at a very high PE ratios. Sometimes they trade at more than 40 to 50 PE ratio. Now there are companies which trade at a low PE ratios. Now these companies are companies which do not have a high growth potential. They do not have a great future. So people don't buy them and they are generally valued at a low PE ratio. But the PE ratios keep changing depending upon the company's fortunes. Now we may come across some companies which are trading at a low PE multiple, though they may be having a great future potential to grow, but they have not been discovered by the market yet and they are trading at a low PE multiple. So these are the perfect companies to be bought for making good returns in future. But it is very difficult to find such companies in the market. Now let us understand price to book ratio. The formula for calculating price to book ratio is market price per share divided by book value per share. Now this is a very important ratio to understand whether the share prices are overvalued or undervalued. Now if you look at the current scenario in the stock exchange, the average listed company in India is trading around a price to book ratio of close to 4. Now if a company in Indian stock market is trading at a price to book ratio of above 4, it can be considered as overvalued. But if the company has a great potential to grow in future, then such kind of price to book ratio can be justified. But if on the other hand there is a company which is trading at a price to book ratio of less than 4 but has a great potential in future in terms of its growth prospects, then it is worth buying. Now those companies which do not have potential to grow in future, they will be trading at a very low price to book ratio, and we should not buy those shares because these shares are not going to move higher. Now let us understand dividend yield ratio. Now the formula for calculating the dividend yield ratio is the dividend declared by the company divided by the market price of the share. Now it's a financial ratio that indicates how much a company pays out in dividends each year relative to its share price. Now there are many investors who are looking for a recurring return along with a capital appreciation. So they look for companies which have a high dividend yield ratio. So they earn a recurring return out of their investments along with the capital appreciation. But normally the companies generally have a very low dividend yield ratio, and those companies which are growing with very fast, high rate, and their market price have gone up, so the dividend yield ratios comes down, because when the market price of the share goes up, then the dividend yield ratio falls. So this is particularly for the companies which are in great demand and growing at a very fast pace.